Adam, welcome back to the Bitcoin Infinity Show.
Thank you for having me on. I don't have the Infinity Ever 21 t-shirt, but I have one in my bag. I should have worn it.
Yeah, well, if you have one in your bag, maybe we should just. No. We didn't coordinate this though.
You have that. You have the hat as well.
Yes. Bitcoin Infinity Academy. Check it out. All right, and I'll say thank you for coming to Finland, and we just wrapped up the BTC HEL conference. Thank you very much for participating, and it was a lot of fun. Everything that you were involved in, including panels with both of us and some fireside chat, and I hope you enjoyed.
Yeah, I think it was a great kickoff event, and I think people enjoyed themselves. It was great content, Bitcoin only content, and one of the curated conferences. I mean, I think the ones I prefer to go to Bitcoin only conferences, obviously, and I think the ones that work better are where the organizers have a view and a vision of what what they want to do. They want it to be educational. They want to show people about this, and they choose the topics and they choose the speakers. Whereas the conferences that tend to go off the rails, they start letting people pay to speak and let them speak about whatever they want, let anybody come, let anybody pay for anything. And then it just turns into, and degrades into a generalized quasi-Bitcoin, but partly shitcoin conference. And then they get less fun. So yeah, good. I think it was good. Like sort of similar kind of vein to like maybe Baltic Honey Badger or something like that, but for the Nordics. It was good.
Yeah, I've said that I'm going to boycott the more shitcoin apologetic conferences going forward, but it's always hard because that's usually where you find the people who don't know the difference yet. So with the Bitcoin only conferences, you're sort of preaching to the choir.
Yeah, that could happen. Yeah.
Well, with this one, we were going for basically a totally new audience. There were a bunch of people there who were at their first Bitcoin conference. I think quite a lot who were also not Bitcoiners at all. So that was the aim for this one. But we'll see about next year.
Do you know roughly how many people came?
Well, we had over 800 ticket sales, and so that's the only metric that we really have, because there were some issues with our scan counting. But over 800 it looks like. I mean,
that's a lot actually for a new conference. I think the one I did in Malta was under 200, and I think so I'm not sure what the count was at the Edinburgh one I went to, but it wasn't huge. It's certainly less than 800. I'm pretty sure. Yeah.
When was that Malta conference? It was a couple of years back?
It was the year before COVID, and we were going to do it the COVID year, and then derailed everything.
All right. Are you planning on doing it again ever?
I'm kind of interested to, but there's a lot going on. So I was talking with actually the Bitcoin Prague guys, because they're in the conference organizing business, and they did a good job in Prague. So I should probably talk to them again. When I first talked to them, it was like the conference was still running. And I think they were too exhausted to think about doing another one right then.
Yeah.
But I hear they're actually looking at doing that now. So maybe
you could talk to our team as well.
Okay. Well, that worked. Yeah.
Game on, Matthias and Martin.
No, we love the Prague guys too. Martin came and had some great feedback, including some actually valuable tips and all this. So
yeah,
we're friends with those guys. Nothing but friends with the other Bitcoin only conference organizers. So.
Yeah, that's the beauty of this thing, and I've seen firsthand that Bitcoin only conferences and Bitcoin ethos aligned people, they want the other guy to do well, whereas when it's more shitcoiny, they see the other guy as competition more.
Yeah. I mean, you see that there's a few curious side effects, like shitcoiners can't meme. Because the people that are showing it, their heart's not in it. They don't believe any of it, right? They're just patrons. And so the memes are pretty weak and not funny.
Yeah.
They miss the mark because there's no truth. And as you say, it's a fierce competition out there for attention, because particularly in the last couple of years, the altcoin market saturated itself and burnt out all of the speculators. And I saw a couple of altcoin promoters writing an open letter to the altcoin promoter ecosystem, pleading with them to slow down the dumps, because it used to be that you could rely on a pump and dump. It would take a year or two, and then it got shorter, and now I think it's like a flash dump, right?
Yeah.
It's over within an hour. So if you don't sell quickly, you'll literally lose money. And so they're burning all of the speculators. And so then there's nobody who wants to play anymore, right?
Alt season is cancelled this year.
Yeah. Well, I think they're having a little go at trying a lost dead cat's bounce or something. I don't know. We'll see. But I mean, I think like midterm, all alts are going to zero. And it's, you know, the network effects of Bitcoin, the credibility of Bitcoin, the decentralization, the fact that it's viewed as a commodity universally, and it has the brand, and, you know, the new types of investors that are coming in, the professional investors, like the people that are managing pension funds or other people's money. So it's good for the individual because they're adding a bit of Bitcoin to a pension fund or to a savings plan. They're not fooled by the altcoins because they're professional investors and they look at it and they can't bring themselves to invest in a speculative Ponzi thing, right? Whereas newcomers are naive. They're not investors at all. So they don't, they just see dollar signs or that the intuition that they missed the boat and Bitcoin's too expensive or stuff like that, right? So I think a lot of the new money is smarter, or more professional, less gullible for that kind of thing, right? So I think it's the alts are going to get downhill from here.
Yeah. It's funny because we had a former shitcoin apologist and philosopher, an old Swedish pop star here at the conference, Alexander Bard. And he's very big in Sweden, and I think he got properly orange pilled here, right? Like the final went over the final hurdle. I was on a panel with him and Grafton from Vexel and Derek Ross promoting Noster stuff.
Mm-hmm.
And you could kind of see the light bulb go on with like all of these freedom tools that he's been talking about for the last 20 years. They're being built on Bitcoin. They're not being built on any other shitcoin network.
It's all about incentives. The shitcoin networks are there to hunt for exit liquidity to dump on. That's it. It's a singular focus.
This is a good segue into the Bitcoin Treasury Companies. Are they, as they say, the shitcoins of this cycle, or is there something there? And what's your? I know you're involved in some of these projects, so I'm curious what your thoughts are around it.
Well, I had a path into them, which is when MicroStrategy started talking about Bitcoin. Now, of course, when they first did it, nobody had any idea they would keep buying Bitcoin. They had a certain amount of money. They offered a share buyback for anybody who didn't like the strategy because it was a big strategy shift. Some people took the money out. I think the majority kept the money in, and then they bought. I think they had 500 million. They bought 275 million worth of Bitcoin. I'm not sure if they kept the rest or some of it probably bought out the shareholders or, didn't like that shift. They were focused on the strategy business. So, and then Saylor was on the news for a couple of days, talking about Bitcoin. And I thought, oh, that's cool. But I didn't expect, I thought that would be the last you'd see of Saylor. He did his PR, he talked about it, and he'd go back to his business. But that's not what happened. So, and then he started doing some other things, which is, and because the argument was clear, it was, fiat inflation in that period, like during COVID and stuff, with the quantitative easing, there's probably double-digit asset price inflation. And he was holding US treasuries and seeing that he's probably losing 10% plus a year on a cash reserves of the company, which they're taking them decades to accumulate, right? So it's like, oh, this is killing us. Like, we've got to find somewhere to protect. So Eric Weiss, who's a friend of his, fund manager, eventually persuaded him. During COVID, he went down the rabbit hole. He went through this whole process. He did it. And then after the initial media blitz, he got busy and started a conference series to show other companies how to do it. And of course, when he did it, it was probably harder because, it's hard to get like auditors and accountants and regulators to understand and fit that into the way they analyze a company and stuff, right? So he was trying to explain to help other companies do it faster, explain what he did. So I thought that's a good mission because I mean, of course, it's more important for individuals to hold Bitcoin because it's about self-sovereignty, and you want most of the coins to be held by individuals. So that's why I'm not too keen on governments buying Bitcoin, actually, because I think that makes it more expensive, and there's still lots of individuals that haven't bought. But for a company, I thought it made sense. And, companies are ultimately, owned by individuals mostly, either directly or indirectly, right? It's either in their self-directed savings plan, or it's in their pension fund, or their managed savings plan, kind of mutual fund kind of thing, right? So I thought, okay, I think this is a good mission. I'd like to support him. So what I thought, well, maybe one way to support him is to buy a bit of his shares, and then maybe if thousands of other Bitcoiners buy a few of his shares, then if Wall Street turns on him, the Bitcoiners will buy the shares and sort of protect because if his share price has really got decimated at that point, it might have killed his proposition, right? So I bought some shares, and then I started trading them a bit. And of course, once you start trading things, you try and figure out, why is the price moving? Why has it got this premium? What is the fair value of this? And so I got, and in the meantime, he was sort of learning things. You can see they're quite transparent about why they did something. And they don't dwell on why it didn't work, but then you see they do something else which they realize works better. So initially they did all corporate bonds. Well, firstly they bought with the cash reserves, and then they started taking corporate bonds, so the debt ratio was going up. And then they got into a bear market, and he just kept, it was kind of shock, sort of positive shock in the market, right? It's like, oh, he's run out of money now, and he'd do it again, and you think, oh no, it's really got to be done. He'll do it again. He just kept going, right? Yeah. And unfortunately, the price, the Bitcoin price was falling into this sort of $15,000 bear market that fell further than anybody expected. And so I think in the bottom of that, he was, and it was, below 30,000 for a while, I guess, right? So there were 5 months where his debt was actually larger than the Bitcoin NAV, which is not a great situation, but it's not like a leveraged position on the exchange where you'd get liquidated if that happened. He's got a company, he's got a bond. If he keeps paying the bond interest, nobody's incentivized to, try and do an activist investor kind of call to liquidate the company because they're going to lose money. And he's paying the interest. They have revenue from the strategy business, so they just plowed through it. And in a way, that high leverage probably helped them accumulate a lot of Bitcoin fast, early. Yeah, I mean, if you had the ability to apply leverage and immunity from liquidation, you can make a fantastic amount of money, but you can't achieve that generally, right? So that was my kind of evolution to thinking about strategy companies. And then I invested in Metaplanet because I knew Batara Eto, who's as a VC interested in Bitcoin, living in Tokyo, and I think he was part of persuading Metaplanet to consider using Bitcoin to start a Japanese Bitcoin Treasury Company. So I invested in that, and that one's much more volatile and high, gets a high MNAV and a low MNAV and like moving around. So that was more challenging to get comfortable with, get confidence to buy it with sometimes quite high MNAVs. So I think, ultimately, of course, people are worried about centralization, and that's a factor because they're going to store Bitcoin in a custodian typically, so that their auditors will be happy with how they're, that it's safe, how they're storing it. And they can grow quite quickly, but it's not really their money. It's like an ETF, New investors are coming in, so the company's market cap is growing primarily because they're raising money to buy, they're selling more shares and raising money that way, typically. So it's sort of growing as like an ETF in a way. But there is a fundamental advantage a company has. So I think there is a rationale for MNAV, which is if you imagine you have a friend who has a dental practice. It's been running for years. That's in many countries, that's a profitable business. They make a lot of money. And he gets into Bitcoin he goes and asks his bank to borrow €1 million, $1 million, and he's going to buy Bitcoin with it. And then he comes to you and say, hey, Knut, would you like to buy 10% of my dental practice? And you can share 10% of this Bitcoin upside, right?
Mm-hmm.
And he's not going to get liquidated on the loan because it's just based on the continued revenue of his dental practice. It's not really collateralized. It's just the bank believes there'll be continuing revenue from people wanting dental work done. So, so far so good. But then he asks you for a premium. And maybe you're a little bit offended, like, you know, I'm your friend. Why are you charging me more than it cost, right? And his argument is, well, look, you know, I have, 3% interest because I have a good credit rating with my business. Try to do it yourself. And you like, you rummage around, you go to the bank, and like, ah, shit, I've already got a mortgage. An unsecured loan is like 7%, and do some calculations, and you're like, okay, I'll pay your premium because it still works out better. And maybe a small premium, maybe 5% because you're thinking, sort of win-win, right? It's he's still getting some upside and you're getting some upside. So that's the kind of private company reason for a premium. And then for a public company, the market basically prices the premium. So, it's whatever the market will pay for the shares divided by the value of the Bitcoin. And public companies generally are sort of more liquid and value things higher, and they're volatile too. Like they overshoot and they undershoot. So I think that's the genesis. Like that there is an advantage for a company, and then they have a lot more tools so they can actually add to it. Right? They can sell convertible notes, which is interesting. So I think Saylor at times has sold like, let me see which way around is this. He'll sell convertible notes with a 50% conversion premium. So he will, raise 150 million, buy Bitcoin today, and then they will convert in the future if and when the share price is 50% higher. And if it does convert, they're only taking on $100 million worth of dilution. So there's $100 million worth more shares, but they're able to buy $150 million of Bitcoin immediately. So you can see that is, 33% benefit in terms of Bitcoin they can buy. So that's he switched from bonds to those because they're a better deal. So that's another reason that even if a company didn't have a premium, you might be able to sell a convertible note and effectively create a premium because people would say, oh, they can do that a few more times, right? And then more recently, what MicroStrategy's been doing is selling preferred shares, which are kind of sort of interest-paying things, relying on the creditworthiness of the company with different tiers of sort of security. So you could be at different levels in the company stack of who would get paid first if the company went bankrupt, basically. But in a normal course, and it doesn't make too much difference, because they've got like 4 of these things now and it gets complicated. But, the highest tier one sort of guaranteeing, as long as the company's solvent, that they will pay you in dollars, the interest rate. And I think the next tier one, it's not quite as high assurance, but it's convertible. So if the share price gets to $1,000, it's, probably $350 or something now. So it's some headroom. Then you've got the option to convert, but in the meantime, they're paying an interest rate with a bit less security. And then there's another one, which I think is a bit more junk bond, he calls it. So, with that one, they can choose to skip paying you a dividend. And of course, if they do skip paying dividends, people will lose trust, but they're not obliged to in the same way. And then the last one is something different. It's trying to be sort of redeemable at par. So you buy some of this. This one is STRC stretch, and they'll try to keep, if you pay $100 and it's paying, I don't know what it's paying, 6% or something. No, they might be 9%. It's like quite a high interest rate. And, if the price of the stretch starts to fall, they'll increase the interest rate. which will push its value up. So they try to keep it tracking so that you should be able to sell it and get your money back. Because normally if you buy a long-term bond and the interest rates, the prime rate or the base rate of the central bank changes, it will change the value of the bond. And so then you might not be able to get your money back. It could go down or it could go up. So he's trying to provide something that is more like a money market fund or something which is paying you, you should be able to take your money out at any time and it should roughly track. And that one was the most successful one. He sold 2.5 billion of that in the first try. The other ones, I think, he sold a lot, but not nearly as much. And he has to sell a lot, has to raise a lot of money because they've got 600 and some thousand Bitcoin, which is worth $70 billion. And so if they want to create, increase the Bitcoin per share by 50% in a year, they've got to raise a lot of money, more than 35 billion, because depending on how they raise it, if they raise 35 billion, but they do it by adding more shares, then that's, the more shares they add, that reduces the Bitcoin per share. So they'd have to do more. But if they do it with these interest-bearing things, then they're not actually increasing the number of shares if they're not convertible. So that's, I just talked about it using MicroStrategy as an example because they've done the biggest variety of things, right? And I think the other one that's done something different and interesting is the blockchain group in Paris, Alexandre Lizette. They've rebranded to Capital B now, or renamed the company, which is a kind of neat name. And that one, they did a convertible note, but Bitcoin basis. So rather than, the thing with a convertible note is until you convert it, it's a debt. And so if it failed to reach a conversion premium and it reached maturity, the company would be obliged to pay you back. And so some of the investors like that, they collect an interest rate and maybe they get conversion, that's the upside, but they get a consolation price, which they get interest and a kind of money back guarantee. They get their money back as long as the company is solvent and can deliver the money. Now, you got to say, especially from the outside, from somebody who doesn't have a view about Bitcoin, that if it doesn't reach conversion premium, the company could have difficulty coming up with the money, right? Because for it to not reach conversion premium, it probably means Bitcoin is low in 5 years. Now, most Bitcoiners wouldn't expect Bitcoin to be lower in 5 years, so they're not too worried. But, some of the people buying these things are just fixed income or, general fund managers who are trying to create a return are looking at it compared to other kinds of corporate bonds, right? It's just they're managing a portfolio. So they may be worried that they don't know if Bitcoin's going up or down or sideways. They don't have a view, right? So for them, that could be a factor. So what Capital B did is they issued a Bitcoin basis convertible note where it's sort of the same thing, except it's Bitcoin denominated. So instead of being a euro debt, it's a Bitcoin debt. And if it reaches a conversion premium, you have the choice to convert it into shares. If it doesn't reach a conversion premium, ultimately in 5 years, they'll give you the Bitcoin back. So it's kind of a more interesting proposition for a Bitcoiner because, Bitcoiners generally have no fiat anyway. So a convertible note where you get the fiat back in 5 years is not very interesting because you think the fiat will be worthless in 5 years. But if you could put Bitcoin into it, and have, the possibility of converting it into shares if they are higher, so if you would make money in Bitcoin terms in this case, then that's good, right? And it's not guaranteed. It could be because Bitcoin's higher because, those are priced in terms of euros. And, because the company is mostly about accumulating Bitcoin, its share price is correlated to Bitcoin. There could be a scenario where the share price is up, but Bitcoin is up more. And then you have the conversion rate. So that wouldn't be as exciting. So it's kind of not 100% connected to Bitcoin, but it's Bitcoin related. So it makes it feel more investable using Bitcoin. So now you might feel more comfortable, buying some of that with Bitcoin. Whereas typically, people holding Bitcoin are not generally very keen on buying shares because, as we all know, Bitcoin is the hurdle rate and you can't beat it.
No.
And now you've taken on some risk and you got to really figure out, do you feel this risk is worth the potential upside? And there are certainly a lot of people who found out the hard way in the last few years that collecting interest on Bitcoin turned into, and then you lose the capital punchline because of a lot of kind of high risk stuff going on. I mean, there's a whole row of companies, right? The guys at the center of it, I guess, the GBTC, ARB, 3 Arrows Capital, which was borrowing Bitcoin to buy the GBTC because it had a premium, and then the premium turned negative, and then they fell apart and defaulted on a lot of their loans, which caused other companies to go bankrupt in a big wave. So there were multiple companies downstream of that, indirectly reselling that yield. And so there are a lot of bankruptcies between like Voyager, Celsius, BlockFi, Genesis, and probably a bunch more that were sort of side effects. So I think from that point of view, a lot of people with Bitcoin who were skeptical about that felt very vindicated that, see, I told you that was risky, right?
Yeah.
And I was one of them because while I was like personally sort of trying to get Bitcoin to work for me to get a low interest rate, I knew firsthand, because I was trying to be low risk, that the interest rate you could achieve in a low risk way was very low. Maybe 2 or 3 or maybe 4% if you're lucky. And these guys were offering 6, 7, 8, 9. They're competing with each other, going higher and higher. And so from my perspective, I was very convinced that that's not possible without some insane risk.
Mm.
It's just like if somebody comes to you and says they got, a low risk proposition paying 10% on euros or dollars, and, the bank is paying like 3%, then there's something wrong with this picture, right? There's some risk in it. So it's kind of like that.
Yeah, I heard Preston Pysh gave a very good lecture about the different MicroStrategy products there a couple of weeks back in the Lugano Summer School.
Oh, yeah.
And he used a lot of metaphors, and one of them was like, imagine them as gears on a bike. So you're going downhill, which is representing Bitcoin's price going up and up, and but in a volatile way. So you might want to switch gears every now and then, and these different products are the different gears on the bike.
Okay.
It's kind of a neat metaphor. One of the things that strikes me is, so the share price theoretically increases because the phenomenon that they're increasing Bitcoins per share, right? That's a base like thesis for why it should go up. But at some point, like, so it's sort of like using the flaws of the fiat system to leverage the main positive of the Bitcoin system, which is number go up technology. So
100%, 100%.
But like, if you extrapolate that into the future, at some point the stock must be so overvalued in comparison to just the base layer Bitcoin. So like, or can it go on forever? And if so, is that what hyperbitcoinization looks like? Because that's where it's ending, right? Like, if it can go on forever, that means hyperbitcoinization in a way.
Yeah. I mean, I think it is. I mean, I look at it as an arbitrage. So, I mean, like an arbitrage is Bitcoin is cheaper in, I don't know, Korea, like South Korea or somewhere. And I don't, maybe that's a bad example, but there were some countries that had like capital controls, and Bitcoin was persistently selling at a premium there because it was a way to get capital out. And then people tried desperately to figure out, how do I get a bank account there? Or they fly backwards and forwards with
Wasn't
cash.
this what SBF was doing?
Yeah, supposedly. And it might be true in some extent, because there were things like that. I saw for a while, I was doing different kinds of exchange Bitcoin arbitrage in 2013, because I could see that BTCE would persistently be 1 or 2% cheaper Bitcoin there compared to Bitstamp. And so I would wire money to BTC, and I didn't trust them. So as soon as I got the notification, I'd snatch the Bitcoin out, put it on Bitstamp, sell it, wire the money back, wait for the notification. So like about once a week, you do this. And if you keep, collecting 1 or 2%, it adds up, right? So
Yeah.
I did it, and eventually BTC, got frozen by some government for something. And luckily for me, I wasn't in it anymore because somebody more professional started arbitraging it, and the price became almost the same. So it wasn't worth it anymore. But yeah, so I think so coming back to Treasury Company, I think it's an arbitrage, but a different one, which is the market is mispricing Bitcoin. They don't get it. So, that's why it feels cheap to me, because you talk to all kinds of people and they're very Bitcoin skeptical. The 15 years of history speaks for itself. It's a kind of screaming buy, but they're like, no, I don't get it. Seems like a Beanie Baby to me. All this kind of, 2015 era doubts. You talk to people and they still have them, right? So, I guess the point is that harder money should be good in a world where people are printing a lot of fiat. And so, if nothing else, it should go up as fast as fiat is going down, right?
Yeah.
And that's pretty fast.
Yeah.
So,
and that's like the low bar.
yeah.
Yeah.
And then you've got the adoption curve on top of it, right? So it's actually going up faster because, of course, as more people come in, as it's scarce, it's going to make it go up faster because it's smaller than fiat. And there's a lot more people that could come in. So, but I do think eventually, Bitcoin gets saturated. Like everybody who wants a Bitcoin allocation has got one, and they've got as much as they want, and the adoption curve will stop because it's done. But there'll still be people who I think it'd still be interesting to hold Bitcoin though.
How could it stop though if fiat keeps losing value?
Well, stop in terms of adoption, not in terms. I think it would become, because I think you're looking at with the Bitcoin history, you're looking at two factors. One is fiat debasing, so the opposite of that, right?
Yeah.
Bitcoin is going up because it's scarce, fiat's going down because it's becoming increasingly debased. And then the other thing you're looking at is the adoption curve, because there were very few people and now there are more people crowding into the same hard money, right? And so what I'm saying is that eventually the adoption curve is done because everybody has it. It's like mobile phones, right? Now I say, you're not going to get, maybe phones get a bit more expensive because they're more featured, but you're not going to get, a huge wave of new users because everybody has the internet.
No, but you're still going to get adoption of more money rather than like people. Like there's the adoption curve of the number of people, but there's also the adoption curve of the number of dollars.
Yeah, that's actually why I was arguing that maybe diminishing returns is wrong, because people are looking at other network effects like the internet adoption and mobile phone adoption. I'm like, yeah, but you only need, 1 or 2 phones. You need like 1 internet connection. Whereas with Bitcoin, originally you're skeptical or uncertain, or you're feeling the risk. So you're conservative, you buy a bit, and then you see all your friends buy, you see the price go up 10 times, and then
you sell all your shares.
Yeah, and then you start, then you just run out of money because you're like, well, it started as 10% and now it's 50%. Maybe I should just get off the fence and
and quit fiat forever.
Yeah, so I'm not sure exactly when it happened for me, but there was definitely a point where, I was counting, what is my savings accounts add up to in dollars or euros or what have you. And there was some point where I was like, no, what counts is how many Bitcoin do you have? And then I just didn't care about, the rest of it at all. So that happens to people. So I think people say Bitcoin is not the unit of account, but it's the unit of savings account. It might eventually become the unit of account for trade, but that's okay. Like savings is probably the more important metric anyway.
Yeah, the theory is that it starts as a store of value and then becomes a meaningless.
I think so.
There are 2 camps here, I think, and 2 schools of thought. And Jeff Booth, in his keynote yesterday, explained the camp that we're in. I think, like, where we firmly believe that fiat and Bitcoin cannot coexist in the long run, because Bitcoin is the literal antidote to fiat. Like, so that they're forces in the opposite direction. And then there's this sort of more sailor-ish camp where he thinks that the dollar and Bitcoin can coexist for a very long time by using and Bitcoin being like slowly but surely becoming the backbone of the other system via these treasury companies and stuff. And like, what's your stance?
I mean, I was taking Safety Namoost's the Bitcoin standard to be, we're going to, his thesis is we're going to return to a gold standard, but Bitcoin is going to be it, and then fiat will disappear or something. To our perspective, fiat has been around forever, but in the arc of history, it's actually a relatively recent phenomena that was originally gold pegged or in some degree gold backed, and then they pulled the plug, and then it became fiat, and then they went crazy. It's actually a relatively short-lived phenomena, right?
Yeah, especially like completely detached fiat, which is
Right.
somewhere around before the First World War, right? And then Nixon is the real pulling the...
Well, that's the famous graph with the arrow that says what happened here or something.
But still, fractional reserve banking predates that by like thousands of years, I'd say, or at least hundreds of years if you count the... when people started trading receipts for gold rather than gold itself.
Yeah.
So in a way, money printing starts there.
It's interesting for me because, I was trying to invest my own money, like trade shares and stuff, in the probably mid to late 90s. And, you quickly learn, you're trying to save, right? So and then you learn about inflation, the government's metrics for inflation. I was living in the UK at the time, and they have consumer price index and retail price index. And then you read some more and you realize, well, they're completely manipulating those things. They're not real. And then you get nervous. So I'm like, well, I'm taking all this risk, doing all this investment, but am I actually beating the index? Not clear. Am I beating the real inflation? Never mind the indexes. That's getting hard, actually. And so somewhere along there, I bought some gold ETFs, and, that people were already talking about, well, yeah, but like the gold is rehypothecated. Some of the gold ETFs are not gold, they're synthetic. They're like shares in gold mining stocks and hedges and stuff. So I researched the array of gold ETFs to find the one that was really physical and not rehypothecated by its own spec, and I bought that one. So it would be kind of disappointing if, Bitcoin eventually ended up in the same situation, being rehypothecated with receipts and stuff, and then not scarce in a way, right?
And paper Bitcoin.
Yeah. And I think, there is a question whether the treasury companies have an element of paper Bitcoin to them.
Not only that, but custodial wallets can totally do fractional reserve right now. The likelihood that every Bitcoiner is going to use up all their Lightning wallets at the same time is super low. So
yeah, it turned out there was some paper Bitcoin that was proven. Of course, if it's discovered that somebody's fractional,
yeah,
and that's and of course nobody wants to advertise that because then nobody will use it, right? So then they will immediately get a rush to the door and it'll be over,
as
right?
it should be. There's no central bank to bail them out.
Yeah. But like it turned out in a bear market that FTX had, I think what they did is they had their hedge fund, right? Alameda.
Yeah.
That was the reason I didn't want to go anywhere near. It looked like they were very solvent, but when you've got a hedge fund that buys an exchange and they're a bit shady, you got to worry that the hedge fund is trading with inside information on the exchange position. So I was like, don't trust that. That's not good. But in any case, it was much worse than that, which is the hedge fund. I think CoinDesk or somebody leaked their Alameda's hedge fund, their portfolio, and it was shockingly bad. It was like a list of no-name shitcoins with leverage on top, right? It's like, that's it? That's your hedge fund? It's a joke, right? And so, of course, that I think that was part of their fall, which is people were shocked and, started to doubt things and take money out, and it tipped them over the edge. But they had, I think what they did is they started borrowing users' assets on exchange and then use them as collateral with Genesis to borrow money to prop up the leverage on their shitcoins. And then they got liquidated anyway. And then Genesis liquidated sold the Bitcoin, which of course caused the price, the market price to tank. And then it all came apart and people realized that they thought they had Bitcoin on FTX, but it was long since sold and so it didn't exist anymore. And they didn't admit it for a long time, right? And they had a lot of, they had their own exchange token, and that they were counting that as if it was hard money, but it's kind of like Terra Luna. If you have this kind of air token, it has a notional price, but the price is based on confidence, and the confidence can evaporate in a day. And then, then they're under collateralized, right?
Yeah, it's the fiat around them find out, as Daniel said the other day. So, would you agree with the statement that the natural state of the market is deflation?
I don't know. I mean, I'm very happy to see the world retry the hard money, prior centuries, gold-based situation. And, safety, I mean, I'm kind of just pragmatic. Let's see how the market progresses. So I was just thinking, when people were talking about safety and like return to a digital gold standard, basically, I'm like, okay, I'm down for that. But let's first pass physical gold, which is a kind of milestone, right? And Bitcoin is like, it's getting more realistic, right? It's like less than 10 times away, even though gold is like 3 times up compared to in the past. Another factor is apparently a lot less of gold is in ETFs than Bitcoin is in ETFs. So if you look at the size of the gold ETF market versus the Bitcoin market, it's not 10 times away. It's like much closer. And so I was even thinking that, a lot of the sort of older generation in the US, I think, are the people that buy the ETFs. They're the people that just want to call a broker and have a verbal conversation to buy something. And so they weren't easily able to get Bitcoin, but now they can buy it by calling their broker. That, it's not new money, it's reallocating from their savings, their portfolio, right? So I think, if they call the broker and say, I want to buy some Bitcoin ETF, and then the broker says, what do you want to sell? They're going to sell the physical gold ETF to buy the physical Bitcoin ETF. It's a logical thing, right?
Mm-hmm.
And so I think because the gold ETF market is a lot smaller proportionally than the Bitcoin ETF market, that could have a more marked effect than people speculate. But I'm not really an expert on the gold market, so I'm not sure. There's presumably some other market for gold where governments are trading physical gold in vaults and stuff. So I don't know how I don't know how the market breaks down in terms of what influences the price, but yeah.
I still think people, like this whole Bitcoin being gold 2.0, it's kind of confused because Bitcoin is very different from gold, even in the scarcity aspect, because gold has a 2 to 3% inflation rate. Yeah. And has had for 5,000 years. We get better and better at finding new gold.
Yep.
And there were like meteorites and stuff that are entirely made of gold. And one of those might crash land at some point. I mean, whilst Bitcoin is absolutely finite, it's like the SAT squeeze is super real. I saw at the pop-up store yesterday, there are two different, there's one screen showing mempool space and another screen showing the time chain calendar. Yeah. And that's pretty neat because they have these circles with different Bitcoin metrics, and one of them is coins found. And you can see that if that circle was a clock, it's like 4 minutes to 12. Like that's how many Bitcoins we've found of all that will ever exist.
I like that Bitcoin calendar. I was talking to that guy. Yeah, there was a guy wearing a calendar T-shirt at the conference. I think it might have been something to do with it.
Oh yeah.
So I was saying it'd be nice if somebody could make a physical clock that's doing this. And it would be possible, I think, because it's not too intricate in the metrics it's saying. So you could make little dials and stepper motors that are tracking the chain.
Fractal Encrypt is the
That's
guy
what
for the job.
That's what he said. He's like, oh, we should talk to Fractal Encrypt and make it happen. Yeah.
Make that thing move.
Yeah, that'd be great.
Awesome. Yeah.
Yeah. So, I think, of course, Bitcoin is a lot more than digital gold. And as you say, it's much harder money. I mean, firstly, the inflation rate or the new supply rate is now a lot lower than gold. But also gold can be reactive. So if the gold price is high, they'll mine faster.
Yeah.
Because they'll be incentivized to do so. Or gold mines that were not economical at $1,000 an ounce are now viable at 3,000. So they go rush and reopen them, and then they work, 3 shifts instead of 1 shift. They crank it up, and that, of course, if you expand the supply, that will take the edge off the price. And Bitcoin doesn't have that.
That's the stock to flow. Yeah.
Yeah, it's pure. I mean, I think, and of course, the other problem with gold is it's funny because the gold bugs like Peter Schiff will argue that gold is better because it has industrial uses and it's used for jewelry, but that's actually an impediment.
Exactly.
Because that's competing with the monetary use. So Bitcoin is a pure monetary use commodity. Yeah. It's actually a better commodity money, in my opinion. And it's not elastic in its rate of supply.
And this is a Misesian point that any other use case for money than the monetary use case actually reduces its functionality as money.
I agree.
And no, so that's one of my. We talked about our favorite memes yesterday at the fireside. One of my favorite ones is a Venn diagram, and in one circle there's people who understand the difficulty adjustment algorithm, and the other circle is people who are against Bitcoin. Yeah. And in the middle of people I've never met. Like there's no one there.
Yeah, it's like an empty set. Yeah, that's great. Yeah. I mean, it's true that the competent and informed Bitcoin critics are just missing. Like, there's nobody. The people that are saying things are just laughably bad takes.
Yeah. There's no. And especially in understanding the difficulty adjustment algorithm, what it actually implies. Yeah. Because it's such a novel thing. Like, we never had that.
Oh, yeah. Yeah, I mean, I was interested in the fastest conversation I ever had explaining Bitcoin's difficulty adjustment was a relative who's a retired 737 pilot.
Mm-hmm.
And is also like a retired, I mean, he did university degree in physics, then was a physics lecturer, then got bored of that, trained to be a pilot, and then flew 737s for many years. And so he's really a kind of brainiac who's always like reading and
sounds like an interesting guy.
Yeah, so I mean, if you ever talk to him, it turns into a monologue where he's giving you a physics lecture, basically. So anyway, I explained Bitcoin to him and the difficulty adjustment. He goes, "Oh, I get it. It's like dynamic control system." And it's like, because there's a lot of dynamic control systems in avionics and flight control. So he was like, "Okay, I believe that." So I was like, "Wow, it's that easy, huh?"
Is he now a fully fledged,
orange pill?
Yeah.
No, I know. And he didn't. He was into like property investment. So I don't think I really got him there.
So it's not a laser ride maxi yet.
Not yet. No. But I was impressed with how fast he got it, and I think that's interesting because I think there's a lot of concepts that go into Bitcoin. So even what he described, now people have to wrap their head around why a dynamic control system would be stable, right? But people he was actually also a flight trainer, right? So he got to, captain, and then if they get better, they get to train new pilots kind of thing. So he was a good pilot. So, of course, he knew the whole thing and how to explain it. And he's super into not just this is how you fly a plane, but this is the physics of it, where it works, right? So he wants to know everything top to bottom. So anyway, for him, it was like immediate. It's no problem. Yeah.
I worked building control systems to start my career, basically, and it's just a funny parallel and totally perfect. I think Lynn Alden has also talked about that.
Oh, yeah.
It's so funny how many metaphors pop up in everyday life, and I guess it's always about finding the one that resonates with someone.
Right, yeah.
Yeah, it's bridging the subjective realm of praxeology with the objective realm of physics, like this. connecting the two.
Yeah, I mean, I have actually found that it's kind of surprising how, because Bitcoin is ultimately a sort of inert piece of software that's running on the internet, but somehow that is able to incentivize and motivate people through like financial incentive. But it turns into a lot more. It turns into like philosophical and almost religious kind of transformation of their being, right?
But this is why I'm so fascinated by it. Like it was fascinated me in the first place. Is like, here's a claim that there's something on the internet that no one can copy, and that's like, but that's impossible. It's data, right?
Right.
And then you realize that the only thing that is not copyable is not the data itself. It's just someone keeping a secret from someone else.
Yeah.
So it means there's always a human being. Like every aspect of it is dependent on the actions of a specific human being.
Well, that's interesting.
So it's
that
not
makes it
actually
real.
a technological thing. It's just this agreement.
Right. Well, the other thing is what you said about the copyability of data.
Yeah.
So we were talking yesterday about NFTs and JPEG spam. I don't want to go there. But pre-Bitcoin, there was always a raging battle, which I think ultimately the recording industry and the motion picture associations lost, about trying to control data exchange on the internet. And so, there's a lot of people that, well, information wants to be free. You can't own a bit string. You can copy it for nothing. Sorry, but that's the internet physics. You might have bought a physical record for a record player, but it's digital now, and we're going to copy it, and there's nothing you can do about it. And, ultimately, the physics of the internet won. So you can't fight physics, right?
No.
It's like fighting gravity. And so then when it comes to Bitcoin, people's immediate reaction, which is fully justified, is like, well, wait a minute, how can it possibly be scarce?
Yeah.
If it's just a string of information, I can copy it. So, okay, you've got the private key. And then I think the other thing is, for the supply to be scarce, it turns out, and it was Saylor that actually, even though he came a lot later, that sort of made it click for the connection there, because he said, Bitcoin is a pull from cyberspace to the real world or something like that. And I was like, actually, that's a good analogy, because what's actually making Bitcoin scarce is the physical process of the proof of work, the mining, the electricity use. So what's scarce is, the mining machines and electricity use, and then, of course, the whole feedback system where you're not going to mine unprofitably. The humans are going to change their behavior if it becomes unprofitable. So effectively, it's, it's very industrial and physical, right? So there's something wholesome about proof of work versus just printing things out of nothing. Yeah,
absolutely. Speaking of copying things, the way I see it, it's the 20th century is actually the anomaly and not the standard. So everything preceding that, you had no mass production. Mm-hmm. A musician, for instance, actually had to go out and play to people. He couldn't just sell CDs or something. And same with movies and whatever. You had a local theater where people played plays. And the 20th century, that's the century we can actually make money off of copies. And that's the anomaly. And you get into the internet age and information wants to be free. So like everything is in the informational realm is actually abundant now. It's just that these old dinosaurs from the 20th century are fighting with the copyright laws and the patent laws and whatever. And we're in this transitory phase where we're trying to figure out how to like make them stop being so annoying about all this stuff that they shouldn't really be doing in the first place. Yeah. And like Bitcoin sort of solves that, because we now have a way to express value to one another without having to respect these 20th century paradigm anomalies.
Yeah, I mean, you say it like that, it's sort of, you could think of it that one of the early criticisms of Bitcoin was it's the digital tulip, right? Yeah. And actually, what you're saying is, no, the fiat century was the paper tulip.
Yeah, everything was tulips then.
Yeah, it's all
exactly.
Tulip.
Yeah,
and it all went wrong. I mean, it was like 100-year tulip, but still a tulip. Yeah. And I think the other thing that I found a bit shockingly surprising about Bitcoin is how slow people are to let go of old bad ideas. It's really hard to get them to shake it. Even though, certainly when I was a child, I remember growing up and like, you see people using money, you assume it, and then you start asking questions like, well,
where does the money come from?
Yeah, and like, well, they can print it. That's how can you, so you sort of learn some stuff, and you're like, children, like some children get in a phase where they want to question everything. And I was always, never trust anything kind of person, right?
Never got out of that phase.
No. So, and yet, of course we've been in it a while, so it's so glaringly obvious to us, but you'd think that, hard data and a hot decade of beating everything by a factor of 10 or something, be like mildly persuasive, but they're still fixated that we're delusional. They're holding on to their fear and to their debt treadmill.
Yeah.
And they can't let go.
Great news. The Bitcoin Infinity Show has a new lead sponsor. This is BitVault, a new multi-sig wallet that lets you not only put Bitcoins into cold storage, but into super duper polar bear meat in your freezer type cold storage using the time lock function. This protects against $15 wrench attacks because the attacker doesn't know that you have this thing running in the background. So you can just secretly take back your Bitcoins while the attacker thinks he got it, sort of. So go to bitvault.sv to find out more. You can use code Infinity for a 10% discount. They have a pre-sale here that's still in beta, but you can get a lifetime deal for $199. This is 100% open source, 100% non-custodial, and there's zero counterparty risk. So what are you waiting for? Check out bitvault.sv right now. And speaking of private keys, you should, of course, take control of your private keys. And you do that by getting yourself a good old hardware wallet. And our favorite is the Bitbox. And they have a new edition called the Bitbox O2 Nova. The Bitbox O2 Nova has a tempered glass display, which is new and shiny. It has next level security because they have the latest security chip installed. And now it works directly with iOS. So you can plug it into your iPhone or your iPad directly, and it will work perfectly for you. It works on all other devices as well, Windows, Linux, Commodore 64, whatever. So go to bitbox.swiss and get a Nova right now. Use code Infinity for 5% off. And if all this responsibility sounds a little too much for you, we have a perfect service to recommend, and that is the bitcoinadvisor.com. These are nice fellows from down under, and they can help you with Bitcoin inheritance planning. It's a collaborative custody solution where you're still 100% in control. Go to the bitcoinadvisor.com to check them out. And I think you can use code Infinity there too. All right, back to the show.
Well, I think I wanted to just segue a little bit into what we usually talk about kind of every year now. I think this is the third year running. I think that's right. Basically around the same time.
Might be. We did one in Prague last time, maybe.
Riga 2 times. We did one before that. I don't remember.
Well, a little bit of a note on the timing here, right? Is that we in Helsinki we decided to put intentionally our date way earlier than Baltic Honey Badger had ever done, so that we would just not conflict with them at all.
And then they moved the date.
They moved their date, and they put it the week before ours, which I think actually worked great for both conferences. Quite a lot of speakers went to both and just stayed in the region, right? So basically, we're doing the third annual kind of Atom Blockstream update here because we've done Riga the last 2 years around the same time. So what's going on with Blockstream and with you? What are you most excited about these days?
I mean, we are sort of always interested in all things Bitcoin. So we've got our fingers into anything that could help Bitcoin reach the next level because the adoption phenomena comes with technical challenges and limitations and scalability questions and ease of use questions and security questions and, even market problems, right? So we're just incentivized to try and improve them, right? And make money along the way so that we can do more of it. That's the basic plan. And so one thing we were able to do recently was, it's been a long running project, the Simplicity sort of next generation smart contracting system, which was conceived of, I think it was in 2012 on Bitcoin IRC. Russell O'Connor was talking about MOST, and he was thinking about, organizing scripts as trees where you only show the branch that you need to spend the coin, basically. But he was actually thinking more about redesigning the full programming system of Bitcoin around that concept. So MOST was added to Bitcoin as part of a taproot mechanism. So you got Schnorr signatures taproot, and part of that is MOST. So the ability to make a branch that you only show if you need to use this condition. And so it saves sort of sending too much data to the chain with things that are not relevant. So I can make a very compact transaction in a normal case, and in a 1% case where I have to close it because say it's a lightning channel and the other guy went offline, I can't reach him. So, okay, finally I have to show some more elaborate hash lock script thing, and it uses up a little bit more space. So simplicity is lower level. So it's more like microcode, sort of bit level operations, and everything's built up out of them. So so the name comes from the individual operations being simple because they're sort of like an AND gate or to concatenate 2 bit strings and simple things like this. And with those 9 operators, you can write any program. And those operators are mathematically defined because they're very, very simple. And you can write a piece of logical mathematics that fully describes their behavior. And then everything is built out of that. So, modern CPUs are built out of AND and OR gates and then different macro structures until you have a whole CPU. So simplicity is built out of this 9 operands, and then you can build effectively any program, but it's not, it's a program that's specialized for blockchains. So there are unique things about blockchains, which is you don't really need to execute a program. You just need to be convinced to verify that the claim is true. And that's why, you don't reveal the branches that are not relevant. And there are some things where it's easier to prove something's true than it is to repeat the calculation. So a simple example is, let's say multiplication is easier than division. It's more work to do division for a computer. Or, factoring is certainly the case, right? It can be very hard to factor a big number, but you can instantly prove it. You just multiply the 2 numbers together and you see it adds up. So, the simplicity language is all designed around that. And then the other kind of unique thing about a blockchain is the programs are only executed once, at least a UTXO blockchain, right? You got a program, you run it, or you in this case, you don't really run it. You just verify that it concludes as true, and you only do it once, and then the coin's spent, and that program is no longer relevant. Now that program might be reused across different transactions, but it's a kind of one-use program. So simplicity is designed around that fact, and it preserves all of the important Bitcoin kind of technical behaviors. So one of them is that baked into Bitcoin's design is that once a transaction is true, like it can be spendable, it won't become untrue. So you can put it in the mempool, you verify if it's correct, and then you put it in the mempool. And so once it's in the mempool, you can leave it there. You don't have to keep looking at it and see, does it still belong there, right? So it's part of the design. So that's true for simplicity programs as well, even though they're more flexible. And it is lower level, so you can do other things with it. So for example, if Bitcoin had simplicity, you could have implemented Schnorr signatures without needing a soft fork. So in some way, it is the lost soft fork, because the hope is that eventually it would go into Bitcoin, but that could be a decade away, and maybe Bitcoin doesn't want it because it's too complicated or something. So I think the pros for it is that ossification, I think, is a useful concept because it seems like as Bitcoin gets larger and there's more value and there's higher tier hierarchical entities with assets in it, it may become more perilous to make changes because, then international banking organizations might have a view about the new opcode, right? And you don't really want to be making software changes with international standards bodies breathing down your neck. And so simplicity is potentially a path to that. And you can see there's an early Satoshi comment on a Bitcoin Talk forum where he says that because of Bitcoin's design, it has to be frozen in all time once it's released. And because he was worried about, supporting use cases he hadn't predicted, he rushed the scripting system before he released it. So it's a kind of combination of things. So you can see that it was kind of an ossification call. I mean, he was assuming it had to be ossified at the beginning, but he didn't. I don't think he realized that soft forks were possible at the time. And then, unfortunately, half of the opcodes he designed turned out to have small bugs in them. So they all got disabled in a sort of precautionary way by some of the early developers. And so the extensibility of Bitcoin was limited by loss of some of those. Like, I think there's opcat, for example, which is quite powerful. So that was lost. And so, simplicity takes you back to that kind of capability, or maybe a bit more because it's lower level. And then, of course, the thing with a low level system is if you build something complicated, it could become big. Now, you don't want, super complicated things, but you could have something that involves some different mathematics or something like that.
It doesn't strike me as a product that every hot dog vendor in the world has been begging for decades now.
It's a kind of long-running project to sort of take Bitcoin to the next level, because it started as a Bitcoin project, right? And so we recruited Russell to work on it and have some more people, Andrew Polstra and some others working on it. And the idea is, well, we can put it in Liquid first, which is the recent news that it's now live in Liquid. And, people can form an opinion of it by trying it, basically. And then, if Bitcoin decides it wants it, good. If it doesn't, it is what it is, right?
Yeah.
So no pressure kind of thing, right? And we've seen in the past that Liquid or Elements, the open source framework, had things that later came to Bitcoin. So there was, I think, check lock time verify was in Liquid first. Schnorr was in Elements that came to Bitcoin 8 years later. So you can see these things take a while.
There was some stuff that was in Ethereum before it was in Bitcoin, right?
Really? Is that true?
I think. Well,
are you sure Ethereum did anything that was usable?
I think that's one of the claims that Ethereum apologists use, that this was copied into Bitcoin. I know before that Litecoin implemented SegWit before Bitcoin.
Yeah, but they grabbed the Bitcoin code and used it.
Yeah, and just copy pasted it.
Yeah. No, I'm not sure. I think Ethereum is mostly a lesson in how not to do things.
Yeah.
I mean, it was not only was it a lesson in how not to do things, but it's predictable that it was going to fail before they did it. And actually, I told them, I was talking with Charles Hoskinson in Skype IM when that was a thing. I was asking questions about, what I thought about, this stateful thing. And I said, it's like a really bad idea. You got to use UTXOs. There's a reason Bitcoin uses UTXOs. So it was an elaborate conversation. He said, can I call you? And I was not really interested in talking to them, but I was like, okay. And there were like a dozen people on the call, like all the Ethereum tech guys. So I felt a bit kind of, I wasn't expecting a group consulting call, but here I am, right? So I just explained how I think it's dangerous. I think they're going to get exploited. You can have interactions because of the state. It'll be hard to make secure. I highly recommend you forget that. Okay, for the UTXO model. And if you're going to do it anyway, make it so that nothing is valid unless it's whitelisted, so you can at least verify them before you allow. And they did none of that stuff, right? So, and actually, I was mentioning to Andrew Polstra that there was an old kind of techie video game called Core Wars, and there's a virtual CPU, and the two of us who are playing the game, we are trying to edit the binary and try and cause the other guy to crash. It's kind of race, I changed this and he changes that, and we change the execution, and I guess it's moving forward. And the aim is to cause, and so, that's Ethereum, right? Because you can write to a shared state, you can create race conditions. And the payoff is, if you can trick the system, you can take their money. And it keeps happening every year. They lose billions,
it's
right?
literally the core wars we're in at the moment.
Yeah. And so, well, yeah, that. And so I mentioned this to Andrew, and he's like, "Oh yeah, I remember you talking about this in 2013 on IRC." So I'm thinking, we gotta go find that. Some of the IRC channels are logged. I think that'd be nice because it was about Ethereum, like in the core wars. It must have been later than 2013. Then, so Ethereum wasn't in discussion until probably 2015 or 14 or something. But it's always because people hear you say something about altcoins and they assume, they like to portray it as, don't you believe in competition, free markets?
Yeah.
That's one theory. Or you're in competition or you're jealous. And like none of those things are true. Like we said it before it existed. We said it when it was an idea, when it had no value, and we're not interested in it. And we think it's all going to go to zero anyway. We just like to limit the, bystander money loss before it goes to zero. But one way to work around that is to find something very old where you said it, before it existed. And apparently there's such a thing. So we're going to go find that one. So anyway, excited about, seeing what people can do with it. And coincidentally, the Starkware guys who are doing hash-based zero-knowledge proofs. So it's sort of more dependable type of cryptography. It's not so experimental. They got interested in simplicity and implemented a Stark proof verifier in Simplicity, which was like, much more ambitious than we were imagining as a kind of hello world or example program. But they did it. So now on Liquid, you could, build some logic that is consuming Stark proofs of another layer or something like that, or something outside the system. So it does demonstrate that it's practical to do complicated things. And the other thing that comes with Simplicity is Simplicity HL, or high-level language for programming these low-level things. It compiles into it that is quite readable. It has variable names and procedures and stuff, and it looks similar to Rust, basically. So it's relatively easy to program.
So this Simplicity and kind of Liquid in general, do you see this, first of all, do you see Simplicity moving into Bitcoin over the next few years? Because I know Bitcoin doesn't move fast, but if it proof of concepts correctly in Liquid, do you see it moving into Bitcoin?
I would be interested to see it. Like, I would advocate for it, but, I'm not the guy that tries to force anything in Bitcoin. Because actually that was where the sidechains came from, which is when I went down the rabbit hole, I realized that the Bitcoin has some kind of privacy problem. So and I'd worked on a previous electronic cash protocols and implement libraries and stuff. So I knew a fair bit about the cryptography. So I tried to adapt some of that cryptography to make it work for Bitcoin, to have some form of confidentiality or privacy. And that's what confidential transactions is. So the vision of that was, I was thinking, let's add it to Bitcoin. So I describe it to the Bitcoin developers, and I get the vibe that this is in 2013 that, this is a bit too much. It's like too complicated, it's too different. They can't really make this change. So it's probably not happening. So, I didn't get pushy. I didn't rage quit. I'm like, okay, let's think of something else. Let's try and find a layer 2 that you can do things with that characteristic. And that's Liquid, basically. So, the same for anything, you got to be relaxed that Bitcoin technical audience and market will, decide to use something or it won't. And if it doesn't, that is what it is, right?
And how is Liquid adoption these days? Because I've personally been using Liquid quite a lot over the last couple of years after finding out things that are useful to me, basically. Yeah. Aqua Wallet and Bolts have done some, we've talked about this in the past, but they make it really easy to basically have Liquid without having channels in a pseudo way. But Anyway, how is the adoption? Is there quite a lot of usage of Liquid these days?
Yeah, there's some new things since we last talked. So the that type of Liquid wallet has accelerated, if anything. And so Bull Bitcoin has written a similar kind of wallet. Peach Wallet has similar kind of wallet, and Breeze, who makes SDKs to help other applications and wallets integrate in better Lightning or to write a Lightning wallet, they had, a standard Lightning wallet, and a standard sort of library to do it in the normal way, and they added this as an option, and they gave it a name, which is Nodeless Lightning. So it didn't really have a name before. It's like, the thing that Aqua did, right? So now it has a name, which is Nodeless Lightning, and apparently it's the dominant choice for people who are using it, because they could choose one or the other, and they choose it. And I think the reason they choose it is that it gives a slightly better user experience, because you don't need the LSP to open a channel to the user to receive money, because you're able to use Bolt's exchanges channels. So it gives you this sort of experience advantage of a custodial Lightning wallet like Wallet Satoshi, which is also easy to use, but custodial in a non-custodial way. So you are, every time you use it, the wallet is really a Liquid wallet, and you're using the Bolt's exchange swap. So you present a Lightning invoice that is going to result in the Bolt's liquidity receiving more Bitcoin over Lightning, and then it will atomically swap it for your Liquid balance, and vice versa. If you send a Lightning payment, you are sending Liquid to Bolt's API, which is going to atomically swap that and deliver Lightning to somebody else. And actually they do something else, which is if both of the wallets are Liquid, they have a hint so they can discover that. And in that case, they make money on it, right? So they make money on all of these things, a little commission on it. So that's proven popular. It sort of avoids the liquidity thing. And if you think about it, it might be more scalable in terms of the footprint on a Bitcoin chain, because you can sort of, you notice that the wallet doesn't have a Lightning channel, so the user doesn't have a Lightning channel. Bolt's does, and Bolt's probably has a lot less Lightning channels, and they can manage them. They're always online, they're monitoring them, they're hand tuning them, and they can open new channels to a new merchant that arises and stuff. So they can make it reliable, and they can tolerate higher on-chain fees because they're fat channels. And so in a way, it's a sort of more scalable form of Lightning from a main chain footprint, but it's pushing usage into Liquid actually. So it's creating more Liquid traffic, and that seems to be a continuing trend. And I think the other advantage those wallets have for people that want stablecoins is Liquid has Tether and some other stablecoins. Has DPIX, which is a Brazilian stablecoin, and there are other wallets. There's SideSwap that has a trusted swap between Liquid assets, so between Liquid Bitcoin, Liquid Tether, Liquid Bitcoin, DPIX, which is a Brazilian stablecoin, and of course also other assets like tokenized treasury company shares. So there's MicroStrategy's been there for over a year. MetaPlanet's been there for like a couple of months now. And so they're able to do those atomic swaps. And so the other wallets like Aqua is using APIs from SideSwap, where you can swap Bitcoin for stablecoin or vice versa in Aqua. And I got to meet the DPIX CEO, I think co-founder, at a conference recently. And he was explaining DPIX, which I didn't know too much about, but apparently it's got very widespread retail store integration. So you can go into a store, give them cash and receive DPIX, or use a point of sale and take DPIX. And then once you have the DPIX, you can atomically swap it on SideSwap for Bitcoin. So this has become a kind of go-to thing in Brazil. So now a lot of Liquid traffic actually turned out to be DPIX kind of onboarding and Bitcoin swapping. And maybe they're using the PIX currency for local things too. I don't know. But they can also swap the PIX for Tether if they're trying to do something like that. So they've got, this kind of atomic swap, which is quite nice. They should emphasize, of course, that with the nodeless Lightning, there are two disadvantages as well. One is the fees are higher. So, for the Noster tipping one sat, that won't be good because the fees might be a lot more than that. And the reason the fees are higher is because you're doing an on-chain liquid transaction, which is, it's low sat per VByte, but it can't compete with Lightning, which can charge you millisats, right? So it's fine for, like $1 or something like that, but it's not good for a sat. So that's one trade-off. And the other trade-off is you are, while it's an atomic swap, so you're not trusting Bolt's exchange and you're not trusting anybody, you are accepting a liquid trade-off, which is a different trade-off to Lightning. So Lightning has a hot wallet risk, Liquid has a federation risk. So it's a trade-off to be aware of. I'd recommend people to do their cold storage on the main chain. BTC Sessions, Ben, has been promoting the idea of, doing daily, like high frequency stacking on Lightning, switching it to Liquid so you don't have to hot wallet risk after a while, and then let that build up so that you're not creating small UTXOs and then cold storing it. So it's kind of workflow. So I think people who are using Liquid-based Lightning wallets should, if they're doing cold storage, they should flip it. And actually, I think Aqua actually has the swap. So you can swap Liquid Bitcoin for Bitcoin and vice versa. And that is using SideSwap, which has an API for doing it.
Would this be a correct metaphor that Lightning is your cash, Liquid is your bank account, and on-chain is obviously your savings account?
Yeah, that's a good analogy, something like that, yeah.
No, I love it. I love hearing what's going on with Liquid because honestly, it seems like everything that the crypto people want to do, it's like, actually, no. The things people want to force onto the main chain, right? You can just do it on Liquid. It seems like it's almost all possible at this point, and yeah, between Liquid and Lightning, it's all there. Yeah.
Right. I mean, I think the other thing that might happen over time is there's been some kind of surprise progress on exploring the limits of what you can do using existing Bitcoin script. So BitVM, Robin Linus's idea, and there are a few projects now trying to implement those.
Is that a good idea though? Doesn't it mess up incentives?
Well, I mean, it's sort of a continuation of the Lightning phenomena, right? Which is, I mean, it depends what people are doing. If they're doing stupid stuff in layer 2, yeah, it's kind of clown show stuff and you probably don't really want it. But if they are doing something sensible, like, investing or making real-time payments or making there's other layer 2s like Arc and stuff. So I think a lot of the layer 2s, Lightning and I think Arc are able to provide a mostly trustless layer 2 because you get a hot wallet risk. But some other layer 2s, like Liquid, it's not really layer 2, it's a sidechain. It's not able to provide that high of a guarantee because it's using federation. And there are HSMs that ultimately have the keys in the federation, and the federation can evolve. So, if a participant goes bankrupt or gets disinterested, they get replaced. But, there's a federation risk. And what the things like BitVM are showing is that you might be able to do a lower trust federation. So a federation where you only need one honest party instead of, some threshold of them. But the downside of it is it's a bit complicated. And with Lightning, you've got what they call a justice transaction, right? You've got a normal transaction and then somebody tries to, close a channel with an incorrect balance from the past, and you've got a way to override them. So that justice transaction on something like BitVM is kind of big, like maybe 100 kilobytes. They're trying to optimize it. That's the current trade-off. Now, with simplicity, you could probably make that small because they're doing, why it's big is they're doing some kind of sort of surprising it's possible, sort of partly verifying a zero knowledge proof using Bitcoin script, and your like first reaction is, what? That's possible? Sort of, yeah.
Yeah, it's funny. If these layer 2s and things, it's different from the spam debate in a lot of ways, but it sort of comes down to a similar thing. Like, why are you forcing things onto the chain when maybe there are other solutions. At the same time, if they're doing what is possible, we can't really stop it. Only try to create new things that are more efficient and better ways of doing it, right?
Well, I mean, I'm somebody who will tell people not to do things, in my opinion. I mean, I can't stop them, but I have opinions about it. So I've got sympathy for that. And there's certainly a lot of history of people doing lazy and inefficient things on the chain. I mean, like Satoshi Dice is an example. And of course, there was the original op return debate, right? Yeah. Where there was like 40 versus 80. And people were like, well, do you really need 80? Yeah, surely you can find a way to do that with your it's like application data, like, typically, right? And the people that want to use application data on a Bitcoin, that's just like laziness, right? Because Bitcoin is a kind of peer-to-peer network, and they're building an app that's kind of peer-to-peer, so there's no server they can call. So they're like, I don't have a peer-to-peer network, let me abuse the Bitcoin one.
Lazy or malicious?
Well, I mean, I think in that case, they're just kind of lazy, but I mean, it is a kind of externality. And then, of course, the other problem is it's probably part of the block size debate, right? Which is, the original developer is lazy, so he puts it on a blockchain, and then the fees go up, and they're like, oh, it's too expensive. Can you increase the block size, right? So you can see there's a bad feedback loop there. So I think what should be on a blockchain is the minimal data necessary for the transactional use case. It's hyper optimized for that. So it's kind of offensive when people put, JPEGs and silly inefficient stuff that doesn't really need to be there, that is displacing hundreds of UTXOs when people have spent, months micro-optimizing it to save a byte here and there, right? There's such a disproportion of, high effort optimization versus low effort spamming or scamming, right? So I got a lot of sympathy for that, but I do think, and then in terms of the ossification, I think and it is like Bitcoin's perfectly viable. You could ossify it now and it would be fine, right?
But how would you ever be able to prove that it has been ossified? Like, you can't prove that, right?
Well, I think that's an interesting question. Could you disable soft fork?
Well,
I don't know.
If it's made up of people, there will be new people next generation, 100 years from now.
You could, ultimately you can make a change to Bitcoin. If everybody agrees, you could hard fork it, right?
Yeah.
But I think it's evidently a lot of work to make soft forking change. And so, of course, SegWit was a bit of an anomaly that caused some shell shock. And say, I think Taproot was people like getting over that, like feeling like you can make changes again. So, but there are definitely people who are looking at it from a savings technology point of view who don't care about anything else. They're like, you talk about Lightning because there's an opcode that can make Lightning more efficient, the APO and those variants, and they don't care. Like, they just care about just don't break the storage tech. And it's true, right?
Yeah.
That would be enough. So, but I think it's like potentially worth sort of focused new features that enable layer 2 to work better. Like, if you can get more efficient, easy to back up, more reliable Lightning, okay, to me, that seems worth it. Some of the savings guys really, they don't care about that.
I would agree with a caveat, and that is as long as those layer 2s are layer 2s that make medium of exchange over space or time easier, but smart contracts, all the other stuff, like, I don't know, like the stuff that potentially changes incentives.
Yeah, it's definitely something that was a factor in side chains and color coins particularly, right? Because every color coin transaction is a Bitcoin transaction. And so I was originally interested in color coins, and I thought, a better way to do it would be on a sidechain, so you're not spamming the chain, right?
And so you're not messing with the fungibility.
Yeah. Well, actually, the sidechain, in a way, because the concern with color coins is that if let's say it's representing shares and, other financial instruments, and they became financially bigger than the Bitcoin value, that could sort of create a horrible, a big incentive problem that somebody is vying to undo the Bitcoin chain because they've got some stuff on top that's not even to do with Bitcoin. And so while the side chains don't have as good of a security connection to Bitcoin, it does mean they can be reorganized without touching Bitcoin. So you've got like that bit of insulation. So you've got some kind of, Bitcoin connection, which is, Bitcoin is a fiat currency. You can put Bitcoin in and out of it with some trade-offs, but it doesn't create the reorg incentive things. Things that create a reorg incentive, like extension blocks, so that's a problem. So yeah, I agree with that. Like Bitcoin itself is more important than those use cases.
And this is not only because I prefer the monetary use case. It's also the logic that the Satoshi is the only thing that is internally valuable to the system itself. Yeah. The system rewards miners in Satoshis, not other shit like the. Right. So that's why that's so crucial.
Yeah.
Would you agree with that?
Well, you don't want to mess with the incentives because, people say Bitcoin is anti-fragile, but that doesn't mean if you throw enough monkey wrenches in there, something couldn't go wrong, right?
It's anti-fragile if we choose to be.
Right. Yeah. So we are the anti-fragility. So I think that is why a lot of people want to ask questions about proposed changes to try and figure out, is this safe? Is it going to create a problem for Bitcoin? And you can see Mr. Hodl on Twitter. That's what he does. He is monitoring for things that might mess with his Bitcoin, and then he attacks them. So it's great, if you want a preview of what Bitcoiners might think about an idea, just go ask him.
Adam, this has been a great conversation. We have to get you out of here pretty soon so you don't miss your flight. But thanks so much again for coming to Helsinki.
Him? Put him somewhere, and did you do another interview tomorrow? And well, let's skip that. So that look,
you could get yourself on a flight to Malta. I mean, the weather is still quite nice here, but it will get colder after a while.
Maybe we'll see you in Malta sooner than later. Thanks for coming to BTC HEL. It really meant a lot to us, and thanks for your time. It's always great to hear your thoughts. We don't have to do a whole lot of work. We just let you tell us all the great new things that are going on, and so thanks again for that too.
Yeah, thanks. And I like the conference name too, BTC HEL.
Yeah, you can say you've been to hell and back now.
Yeah, and the airport code is HEL too, which is cool.
It's why it works, I think. So yeah. Hey, thanks again, Adam, and yep.
Thanks a lot, man. See you in a year, if not earlier. I think earlier.
Yeah. All right.
This has been the Bitcoin Infinity Show. Thank you for listening.